Okay, so Chapter 12, Mutual Funds and Exchange Traded Funds. Chapter 12 is important because this is primarily where most of your stock investing money will go over your lifetime. So for most people, um, a good significant portion of your investing will be in mutual funds and exchange traded funds. Some of it's unavoidable. When you get a job and they offer you a 401k, the only options are mutual funds or index funds. So that's why you're going to be forced to be involved with these instruments. They're not as efficient or effective as building your own portfolios, which you may want to do in your own brokerage account. So if you have your own brokerage account, you may actually want to, if you feel comfortable and you feel like you've done enough self-study after this course, and you can kind of dabble a little bit, start slow with a little bit of money, don't bet the farm, as they say, maybe buy, find some lower price stocks, buy 100 shares or something that's like between $5 and $10. And, if you see that you're doing well, maybe over a lifetime you kind of build and expand on your personal portfolio. But your retirement portfolios are primarily going to be invested in mutual funds and exchange traded funds. So it's important to understand the basics of these and how they, what the ins and outs of them. And I can tell you right now, the disappointing part is that these mutual funds are controlled by big financial companies, and the big financial companies are in business to make money, and that money is going to come from the gains of the mutual fund. So if a mutual fund makes a 12% gain, they may take 2 as their fees for providing you the services and the management to run the mutual fund, and then you only get a 10% return. So this is sort of your payment for their time being involved in the mutual fund. So today we're going to go over the basics of mutual funds, and what they do have to offer to investors. We're going to talk about the difference between an opened and a closed-ended mutual fund, exchange-traded funds, which are very popular, types of professionally managed companies, and discuss various loads and fees and charge structures. We're going to talk about the types of funds available to invest in, the investment objectives, talk about investor services mutual fund companies can offer to investors, different ways you can utilize mutual funds for your investment purposes, and the source of return, well, computing a rate of return earned on the mutual fund investment. So these are just different things. Now, the mutual fund goes way back to 1924, and if you remember in 1924, that was a bubble boom time for stocks, kind of like what we had in the year 2000. We had a bubble in stocks in 2000 in tech stocks. In 2007, we had a bubble in real estate. And now in our current year, we have sort of a bubble again developing in the tech area. No one's quite sure it's a bubble until it actually deflates. While it's inflating, we like to pretend it's not a bubble, that this is reality, a new reality, and that the stocks are valued this much. And it's a nice fantasy to believe because you keep making money in this fantasy. But a harsh reality can come if the valuations and the earnings of the stocks can't match the accelerated growth of the stock price. Eventually that will correct. And so if the stocks suddenly do perform as anticipated and generate very lucrative amounts of profits, then the bubble will be less threatening because the stocks are growing into the valuation space that the stock prices hold. But if the stock market bubble does break, which it has done on numerous occasions, then it's a long, prolonged period of pain and grief and suffering and crying and 50% of your portfolio disappearing in some cases. And that's what happens if you're a mutual fund investor. Say you get your job and you're investing in mutual funds in your 401k. You should never market time with these mutual funds. Just leave the money invested continuously, dollar cost average, and continuously buy into these mutual funds. And sometimes you may have a period where your mutual fund account has grown tremendously and it's a large number in there. Then some sort of correction or crash happens and you could lose 30, 40, 50% of the value. This is the critical point. You don't want to sell when this happens. Just hold steady. The values will return. Don't give up on stocks. In fact, at this point, you would want to accelerate investing into stocks and buying at a lower price if you can. So with mutual funds, you never want to market time these mutual funds. Just let the bad news happen. Let the funds shrink, knowing that you're dollar cost averaging, you're buying more shares at a lower price, and eventually you'll go into a time where the market will expand again, and you'll have even more money than the previous high. So you just have to be willing to accommodate this up and down movement of stock prices through time as part of one of the stresses and one of the realities of saving for investment. And we put up with these extreme market fluctuations because stocks are the only vehicle that consistently beat inflation, and the only vehicle that will consistently deliver a return that will create enough money for you to retire with. Okay, so they were started in 1924. By 1940, there were 68 mutual funds. 2011, there were 8,600 funds with an estimated value of $11.6 trillion under assets. Now, I think that's the 2011. Today, we're getting closer to the 10,000 threshold of mutual funds, and I think 17 trillion of value under assets, because this is how much we moved up since 2011. A huge increase in the value of these mutual funds. Oh, okay. So actually, there are more mutual funds in existence today than stocks listed on the New York and the Amex combined. So if you took all the stocks in the New York Stock Exchange, added the number of stocks listed in the New York Stock Exchange, added the number of stocks listed on the American Stock Exchange, that is a smaller number than the amount of outstanding mutual funds. There are so many mutual funds, they outnumber the stocks on these two exchanges. And 45% of all U.S. households hold a mutual fund, which now is closer to 50%. So a lot of Americans have money in mutual funds because it's the way the retirement structure is set up is that you can only invest in mutual funds for the most part. Now, what mutual funds do that's very attractive for portfolios, for investment, and for you in general is that it creates an automatic diversification for you. So you just buy this one instrument, the mutual fund, and you're suddenly diversified in many different stocks. It's professionally managed by professionals who've completed a finance degree or two, and they have a history and experience trading stocks. So these are people who do this for a living. And as the theory goes, they should be better at it than you. Some of the research indicates that that might necessarily be true, though. You have the ability to invest very small amounts. You can invest $1,000 and have a part ownership in 30 to 100 different companies. And of course, the mutual funds are here to service, so they do have a lot of different aspects to the mutual funds to help them make it more convenient for you to buy and sell, and your record keeping and keeping track of returns. The mutual fund companies will do all this for you. Not for free though, but for a fee. So the drawbacks are the cost. There are management fees, commissions, loads. So they cost more than developing your own portfolio, and you have a lower than market performance. The average mutual fund consistently fails to beat the market. So the average large cap mutual fund consistently fails to beat the S&P 500. Which has no management. It's just a group of 500 stocks, and whatever happens. It's just 500 stocks. So there's no management involved at all in the S&P 500 index. It's just 500 stocks they threw together. And mutual fund managers in the large sector have a very hard time beating this stagnant 500 stocks. So that's disappointing. You expect that these professionals and these mutual fund managers would routinely beat the indexes, since they have the ability to buy more of the better stocks and sell the less attractive stocks out of that group of 500 large companies. But they just don't, they're not able to really do that too often. Okay. So here's a nice chart. The comparative performance of managed mutual funds versus market benchmarks. I'm not exactly sure what this is trying to show. Managed mutual funds versus market benchmarks. I'm thinking that these are the percentage of the funds that actually beat the benchmarks. So 25% of bond markets beat the benchmark, 23% of money markets, 12% of, I can't tell these colors on that screen. 12% of world markets beat, 23% of money markets, 7% of hybrid. That's a mix of bonds and equity. And 33% of domestic equity beat the index that they're tied to. I think, all right. So mutual funds are organized within a family of funds. So you could have Fidelity's family of mutual funds, Vanguard's family of mutual funds, Barron's family of mutual funds. So generally there's a company that runs a family of funds, and the management company does all the daily operations, file all the taxes, all the legal obligations, preparing information to be distributed to investors and things of that nature. Now, an investment advisor can help buy and sell stocks or bonds and oversee the investment portfolio for the mutual fund company. And the distributor would be the one who's actually going to offer shares directly to the public or through brokers and brokerages. And the mutual fund company will be the custodial entity that's going to safeguard all the securities and stock certificates, and the transfer agent that's going to help keep track of the purchases and redemption requests from shareholders. So basically, the mutual fund company is going to organize and develop the mutual fund products to offer to you of all different flavors and sizes with different toppings, and then you as when you buy into these mutual funds, they will do all the record keeping for you, all the tax work, all the organization, and print all the data, the information of what they're doing and what they're trying to achieve for you. So they basically handle everything. It's just like hiring a landscaper for your house. Landscaper comes in and does the fertilization, the seeding, the cutting of the grass, the edging of the lawn, keeping everything look nice, and you don't got to worry about it. So that's a great upside. Someone comes and takes care of all your outside maintenance. What's the downside of that? You got to pay for it, right? Me and you probably have experience with this because we probably own a house. I don't think anybody else here would own a house, but when you do, you quickly get tired of mowing that lawn. And you may be the landscaper for your house, for your parents, and that's one reason you have kids is so they can start landscaping for you, and you kind of save a little bit of money on that. But kids today are not happy being landscapers. All right. But that's basically an analogy for a mutual fund company. So if you want someone else to do it for you, you got to pay. Now, the open-ended mutual funds are the most common mutual funds, and this just means that they have as many shares as people want to buy. So they're open-ended, and they could create and sell directly through, without a secondary market, and they just keep creating new shares, unlimited amounts of shares, until they actually say, we're going to stop. They're able to really issue as many shares. And basically, as it works, is if you want to buy into the mutual fund, we just figure out what the value of it is currently, and you pay that for the additional shares, and then we get that money and we'll buy more stocks with it. So we want to, the price of the open-ended mutual fund is going to be exactly the net asset value. So you take all of the assets of all the securities in the mutual fund, divide by the number of shares, and we come out with the value per share. So if you want to buy more shares of this mutual fund, that's what you're paying. So you're buying in at the current value. And then if we get a lot of people buying in at the current value, we have a pool of cash. We're going to take that and buy more shares of our existing stocks just to make it bigger. And that's how we can have these billion-dollar mutual funds, because they can just keep growing and growing. And as a mutual fund gets popular and makes a better return, it grows and grows. But the problem is, once it gets too big, it's more difficult to manage, because there are limits on how many shares and what percentage of ownership a mutual fund can have into one company. So as soon as they reach those limits on some of the more attractive companies, which happen to be smaller, they have to go and buy bigger companies. And as the mutual fund gets bigger and bigger, they're going to start buying companies that they may not be their first or second or 100th choice, but they're buying it simply because they've run out of the other options to buy, and they have to keep it invested in the stock market. And the drawback of this is that you don't really know what the price of the mutual fund is until after the market closes, because it doesn't trade during the day. So you don't know if you initiate the buy order during the day, you won't know what you're paying until the end of the day. Okay. Now, closed-ended investment mutual funds or investment companies are the opposite. They have a fixed amount of shares. So you can only buy shares in the secondary market from somebody else that's willing to sell them. So they have a limited number of shares. Now, this helps the management team working on the mutual fund because they don't have to worry about managing cash inflow and outflow. Because picture this, you're running a mutual fund, suddenly there's a scare and a lot of people want to sell the mutual fund to get their cash out because they're worried stock prices are going to go lower. Now you have to go and sell stocks to generate the cash to pay these people out. It's very difficult to maintain a good long-term strategy or buy a lot of good stocks during a downward turn because everybody's liquidating their mutual funds and the open-ended mutual funds. The closed-ended has a fixed amount of shares. So the mutual fund manager gets a X amount of cash day one when they issue the mutual fund. And that's it. They don't get any more cash infusions. They don't have to do any cash payouts because the stocks are fixed and you trade them back and forth and they have nothing to do with it anymore. But this can develop a discount or premium to the net asset value. So the net asset value may be $15, but it could sell at $18 or $20 if people are lining up and creating demand for this closed-ended mutual fund, just like a stock. And in some cases, people may be selling it more rapidly, and they may actually sell at a discount to what its actual value is. And that happens during a panic when people get scared and they want to just sell the shares. And they could drive, it could be a net asset value of $15, but it could go down to an actual price of 11. So that means that there's a real value building up in these closed-ended mutual funds. Now, the closed-ended mutual funds generally aren't as profitable for mutual fund companies because you can't expand them too rapidly. So you have to you have a size limit of how big these closed-ended mutual funds. So a lot of these closed-ended mutual funds will start with, closed-ended mutual fund 1, and then they'll open up a second closed-ended mutual fund and a third closed-ended mutual fund. Each trade with a separate ticker, each trade independently. So you have 3 different mutual funds all doing the same thing, but we had to open up a whole second closed-ended mutual fund because we ran out of capacity and there's too much demand. So that's how they usually expand. So that's why they gravitated to the open-ended because they're a lot easier to facilitate and grow. Now we have a new wrinkle in the mutual fund market. A new competitor emerges in the 1990s called exchange-traded funds, ETFs. And these are basically answering the problem of why do these professionally managed mutual funds not beat the markets? So why would I want to invest in a professionally managed mutual fund if they can't beat the market? So the answer was, let's create a mutual fund-like entity that has a lower cost structure, it is non-managed, and should have better returns. So they created these ETFs, which are just a basket of stocks that track a specific index. So they find like the S&P 500 index or the NASDAQ, and they say, okay, what stocks are in there? And let's purchase that same exact grouping of stocks, and we'll mimic the index. And there'll be no professional analysis. We're just going to exactly copy the index, and we'll sell it, and we'll transform it into a security and trade it like a stock. So you can buy or sell ETFs during the day. The valuations are constantly computed. Very low management fees and expenses. There's also generally a lower tax burden since they're not trading. Every time a mutual fund manager buys and sells the stocks to make a capital gains, you got to pay the tax on it. So the mutual funds, they don't themselves pay the capital gains tax or the dividend tax. They pass it on to you. So if they're buying and selling a lot, you're going to have high tax liabilities for these mutual funds. If you buy an ETF who just have, the 30 stocks in the Dow Jones Industrial Average, they're not going to be selling those stocks. They're always going to be owning them. So there's very little tax that you have to pay. It would only be the dividends that are paid. And since they're unmanaged and they're traded with very little need of a mutual fund manager, they don't have to pay all those salaries to hire those people to manage and manipulate and evaluate stocks. So they typically have a much lower cost structure. Now, for going back to mutual funds, You have mutual funds that have a load, which means you have to pay a commission at the time of purchasing the mutual fund. So if you want to invest $10,000 in the mutual fund, you may have to come up with, you know, $10,000 plus 2% of that amount. Maybe that's $200 as a load fee, and that goes to pay the commission of the broker. So additional, so you have to come up with $10,200 to buy the fund because of this load. Some mutual funds may not have a load. They may be specified as a no load fund or a low load fund, which they're going to be a lower percentage. Some of these loads can be 5-10% of the fund, and they could be placed at the front end load when you first buy it or a back end load when you sell it. And that's tricky. So if there's a back end load, you may not realize it. Then you go to sell it, and suddenly they're keeping 5 or 10% of your profits, or not your profits, your total value of the mutual fund. So you want to read whatever literature or perspective they provide you on these mutual funds to know. And some mutual funds may set it up that if you trade it within a month, you get hit with additional penalties. So it's like signing up for a credit card. There's a lot of fine print that you have to understand what you're getting yourself into. Because they don't want you day trading these. They don't want you buying and selling them too quickly, so they have all these fees meant to encourage you to retain your money inside of them. Now, so that back-ended load I was explaining before, this is charged in the sale of the mutual fund rather than the purchase. So additional fee. And then they needed more money, so they came up with something called the 12B-1 fee. A very boring name they hope that no one would ever look into on the perspective of these mutual funds, but it's basically a charge that for mutual funds to cover additional management costs of running the mutual fund. So now additional fees being applied. In addition to that 12B-1 fee, there is a typical management fee that you're going to pay to compensate all the professionals and staff working on the mutual fund for you. Administrative costs of doing business and expenses such as marketing and things, you'll also pay for that. And any taxes the mutual fund company generates, you will also pay in their trading. You'll be responsible for. There was one mutual fund company called Barron's Funds, and they every year they have an annual party, which they say isn't coming out of the fees of the mutual fund, but it's coming out of the money that the company generates as a profit, which are basically based on the fees of the mutual fund. So they make that statement, but I don't believe it. But they throw this great party. It's in a Lincoln Center, and they have about 4,000 members go. I go every year. It's great. They usually have big concerts. Last couple of times I went, they had Bon Jovi. Now they have multiple concerts. At lunchtime, they have a concert series when you're eating lunch. I saw John Cougar Mellencamp on lunch, Harry Connick Jr., the Eagles. Then they have a big performance at the end of the day once the mutual fund conference is over. It's sort of basically they're updating you on the stock markets, and then all the mutual fund managers talk to you and encourage you to buy more of their mutual funds at the end of the day. At the very end of the show, they had the big concert. In the last couple of years, they had Bon Jovi, Celine Dion, Jerry Seinfeld. Sometimes they do comedy. So they get these big performers to come. And then the food is just fantastic all day long with food and snacks, but it's a sales tool because these mutual fund they don't do this to thank you as much as they do this to encourage you to buy more of their mutual funds. So they could say, and they usually are good. They usually beat the market. So they have a lot to say and a lot to say, listen, you should buy more because we beat the market. And so it's a big sales tool. So there's a lot of money in the expenses of running and advertising and promoting these mutual funds, but you're paying for all of it, plus the profit that the company needs to make by running these mutual funds. This is a just a chart. I know you can't read it too easily, but it just goes over the fee table required by law. So each mutual fund has to break out and detail the fees that you're going to pay, and give you an example of what that would cost in, say, a $10,000 investment, how much that would cost over 10 years. So they need to give you sort of a breakdown of what you're really paying. So by law, in the past, before this law was here, they would not tell you this so easily or make it so easy to understand. But the law, said that you have to break out and specifically show the investor directly what they're paying for when they get their mutual fund and how much this could total likely be over a certain period of time. Now, the unit investment trust this is sort of a ETF before the ETFs were really defined, and it was another fixed pool of securities, not like a mutual fund, because it's not actively traded. This was sort of the originator of to the ETF. So before the exchange traded fund was developed, they had these unit investment trusts, which were a non-managed pool of securities that you could buy into that wouldn't have all the fees of a mutual fund, but they were very awkward investment for investors to work with and companies to manage. So they sort of disappeared, and the ETF was developed to replace it. Now, there is a special type of mutual fund called a REIT, or Real Estate Investment Trusts. And this is a mutual fund. Generally, they're closed-ended funds, and they buy properties or real estate. And so it's a way not to invest in stocks, but to invest directly in real estate. And a lot of these real estate investment trusts can be invested in mortgages, so they could buy some of those securitized mortgages, and then you get that rate of interest return. They could be actual sets of properties. There's some of these REITs that go and buy prisons, and they rent them out to states. So the real estate is the prison and the grounds, and they rent the property to the state. Or they could be shopping malls, or they could be hotels or apartment buildings. So it's a business basically that instead of you being the individual person owning the apartment building or the mall complex, these real estate investment trusts pool all of the investors' monies together, and they go out and they buy maybe 100 different shopping plazas, and then rent it out to supermarkets and Target and things like that. And that rental income, less the property upkeep and taxes, becomes the profits that they return to you as a dividend. So this is a way of having an investment that's even more diversified away from stocks and bonds. So this would have been, real estate investment trusts were, well, actually in 2009, after the great stock market, Great Recession and the crash of the stock market going down 50%, and the crash of the real estate market, anywhere you put your money in 2009 was a good place. But real estate investment trusts have been doing well ever since the recovery of the real estate markets. But one area where they're not doing too well is the mall. So regional malls across the country have been experiencing a huge slowdown in traffic and a huge reduction in the profitability of the rents they can charge. And most of that's blamed on you guys, because you guys are not hanging out at the mall, because you're buying everything from Amazon, and the mall is less accommodating. It used to be, 14 to 24-year-olds were at the mall quite often buying a lot of stuff, but now the mall is no fun for you guys. So you'd rather stay home online. So traffic has decreased at the mall, and overall rents they can charge have decreased as well. So that would be any real estate investment trust focuses on malls. I would not be not be a good investment. But the plazas are still doing well. The hotels, the apartment buildings, hospitals, even prisons. Those are all doing. REITs are all doing very well. Okay, hedge funds. Everybody's interested in hedge funds because they make so much profit and money, but not for you, for the super rich, the 1%, maybe the top 10%. You can't invest in a hedge fund unless you're what they call an accredited investor. You have $1 million worth of net worth and annual income greater than $200,000. Otherwise, they don't want to know you. So these big hedge funds, they're looking for big money. They don't want to deal with people's nonsense of investing $1,000 or anything like that. Okay, so this accredited investor dollar amounts, this is just an average. It changes. The hedge funds themselves set these numbers, and these can change from hedge fund to hedge fund. But generally, hedge funds only want to deal with the big money. Now, it's great to be a hedge fund manager because you can get 10 to 20% returns of the profits. And actually, so the general partner can get 10 to 20% of the profits of the hedge fund. You can't do that running a mutual fund. A mutual fund manager or a mutual fund owner our partner doesn't get that much percentage. They can only get the fees, maybe up to 5%. But the hedge fund partners get a lot more money. That's why you read about these hedge fund owners that have so terrific amounts of income, and there's a hedge fund operator that makes over $1 billion a year or multiple $1 billion a year, is quite generous in donating money back to the campus to build new buildings and statues and invest in different projects on campus because they run a very successful hedge fund for the super rich, and they claiming 10 to 20% of the returns can get you an income of anywhere from $2 to $10 billion a year. It's really an insane amount of money. Now these hedge funds are not regulated by the government as heavily as mutual funds. So they don't have to operate the same mutual fund regulations that are put in place to protect the investor. So certain things mutual funds can't do, but hedge funds can do whatever they want because they're private limited partnerships. So it's sort of like joining a business. And they can pretty much do whatever strategies they want, aggressive strategies, as sort of this, you've heard a lot lately, if you have any eye open or ear open in the business world, you've heard a lot about this high frequency trading. That's a hallmark of hedge funds. And it's basically this trading where you're trying to get a split second ahead of most of the orders, so you know kind of the direction of the order, so you can kind of trade to the advantage of that. And hedge funds use all sorts of strategies and arbitrage and options and short selling and other complex mathematical algorithms that will help to give them a slight edge over the typical investor and rake in millions and millions of dollars. And they're highly leveraged, so maybe they have 100 billion in assets and they'll leverage it up to a few trillion in investments. And that's how they can generate such widely successful returns, because they're so highly leveraged. So hedge funds are very exciting. A lot of people think they can invest in hedge funds, which you can't unless you really have a lot of money. And a lot of students think they're going to get a job working in a hedge fund, which you're not, because there's not a lot of positions, and they usually hold them open for mathematical geniuses, not business student graduates. You can go maybe work in a mutual fund, but the hedge fund are for that select 1% of ultra smart, ultra successful mathematical students across the country with the quantitative abilities to think up of these mathematical formulas that will produce such aggressive returns. So if you want to work at a hedge fund, you need to go get a math degree. That's who works there. Okay, so different types of mutual funds. We have our growth mutual fund, which is by far the most popular. People love the growth mutual fund. And this is a mutual fund that invests in stocks that are likely to grow. Technology companies, social media, Netflix, promising biotechnical companies and biomedical pharmacies, pharmaceuticals. So we're looking for companies that are going to grow, and companies that grow generally produce a better return. So it's a very popular but riskier type of mutual fund. Now, if that isn't risky enough, we have the aggressive growth, like a lot of our personal traders here in the virtual stock market, where you're very aggressively buying and trading stocks at a very aggressive nature to make a high return. And some of you, it's working out quite nicely. Others of you, you're losing a lot of money. And that's sort of the ball game when you're highly speculative and you're betting a lot on risky companies that have potential but a lot of risks. So, but if you have a very long time horizon, some of these aggressive growth funds will give up better return than just a regular growth fund. Now, for older people like myself, we may prefer a value fund, which focuses a little bit more on the intrinsic value of the stock. What is the stock? The value of the stock should be. And then if that value is greater than the stock market is trading at, so the value of the company is really $30 and the stock's trading for $15, we'd want to buy that. So we look for maybe a low PE as an indicator of value. We look for the undiscovered companies that people haven't fallen in love with yet, and we try to put together a portfolio of stocks that generally are going to have they're underappreciated right now, but eventually, because of their earnings and their growth that will develop in the future, the stock price will have to go up. And sometimes companies that aren't really Not every company is as sexy as Google, Netflix, or Apple. And those stock prices go up because people know the companies, they want to be involved. Some companies deal with waste management or nuclear construction of nuclear facilities, or um, facilitating administration of hospitals. It's just a bunch of different things that you may have no interest or connection to. So it's not really something that, people buy what they know, and they buy what's hot. So a lot of stocks are cool, but they may hold significant value to be uncovered one day when the story just gets um, too convincing and investors pile in, or sort of the enlightenment of the market shifts over and these stocks get a little bit more highlighted. Equity fund, income funds. Here we're looking at preserving our capital, but yet generating income. So we want to generate a lot of income through dividends. So this can be a less risky type of mutual fund to be involved in, but yet we're looking for stocks that are going to pay us a decent dividend. Preferred stocks or utility stocks, something where the stock price is not so volatile, but the dividends are more consistent. And this would be somebody who's more closer to retirement that would want to be in a safer group. We can have what's called a balanced fund, where we're blending between bonds and stocks. So typically bonds and stocks move in opposite directions. So their correlation is smaller or negative. So they sort of make a less risky, a more diversified portfolio. So a safer fund for people closer to retirement may be a balanced fund between stocks and bonds. We can have a hybrid type of fund, like sort of growth and income. So we're looking for growth stocks that are likely to pay or increase the payments of dividends. And we can also throw into this a set of bonds that will likely are going to be paying dividends as well. So we sort of blend the best of all the worlds. We could have the growth of growth stocks, and we can have the dividend of certain stocks that are growth stocks and pay a dividend, and we can have the emphasis on some blend is some fixed in securities, but these fixed income securities may be a little bit riskier, so they pay higher dividends. But they're securities tied to growth stocks. So a bond is just a company looking to borrow money. So if a growth company is looking to borrow money, they're a little bit riskier, so their bonds pay more interest. So we might put in more of a blend of bonds, and then we can kind of adjust them back and forth as we feel the management feels where we should be more heavily weighted. So it's a little bit more, it takes a little bit more management, and these typically charge sometimes more fees, but you'll be able to tolerate the ups and downs of the market a little bit better because they can swing back and forth. A straight bond fund is just bonds or fixed income securities, as they're also known as. And in the bond funds, we could have all different types of bond funds: municipal, government, corporate, high yield, short-term, long-term. They can slice and dice it in many different ways. There's a lot of different types of bonds out there. But the bonds are considered less riskier than stocks and more steady of an income. And sometimes the steadiness of the income helps to make up for any fluctuations in the share price over time of these bonds. So for individuals who are closer to retirement, or individuals that don't want to tolerate as much risk, they may be more interested in putting their money in a bond fund. And bond funds can range from a very low risk, like government bond funds are very low risk, to higher risk, like high yield corporate bond funds. We used to call those junk bonds, but now no one likes to be called junk. So we changed it to high yield corporate bonds. And these are just bonds that pay higher interest rates because they're riskier. Then the high grade corporate bonds may pay, say, 5%, and the high yield may pay 8%. Convertible bonds that can suddenly convert like a transformer into stock. So one day this bond is a car driving down the road. The next minute it goes and turns into a stock. So that's pretty convenient, right? Who would want to play with that? Or have a movie series based on that, starring Mark Wahlberg, coming out this summer. There's also the mortgage-backed bonds. these used to be considered safe until they blew up and we had that huge crisis in 2008 and 9 on mortgage-backed securities. They've tightened up the lending requirements and the way they securitize these, so they're back to being safer again, except mortgage interest rates are so low they don't pay much anymore. So it used to be that you could get a good 7-8% return on these mortgage-backed securities, but now we're talking 3 to 4%. So they're not as popular anymore based on that, what had happened. Now, municipal bonds are a special type of bond, and they have a superpower. And their superpower is you pay no tax. So that's, very attractive for someone that, say you're in a combined state and federal tax bracket of 35%. So any bond, if you get a normal bond paying $1,000 dividends, you're paying $350 of taxes on that $1,000 dividends. Or you can have a municipal bond for the same amount of money invested, and that pays you $800. But that's totally tax-free. So you actually get, after taxes, you have more from the municipal than you do from the treasury or the corporate because they have to pay certain taxes. So municipals are unique that they can be state and federally tax-free. Municipal state bonds. If you're looking at government treasuries, they're only state tax-free, not federal tax-free. And then bonds, there could be a bond fund that focuses on bonds that have a duration or maturity of between 7 to 10 years. So they're shorter term rather than, and then short-term bonds, they're going to have a life of 2 to 5 years. And the difference between intermediate, short-term, and long-term bonds is what we call a bond yield. So the sooner you get your money, the less risky it is, so the lower that yield is. The longer it takes to get your money, the higher the interest rate it pays you because it's riskier because you got to wait 30 years to get your money back. So that's why they group these bond funds in different time slot segments because they have different risks and different interest rates. Now, a money market fund is, if you go to any bank, they'll have a money market possible fund for you. And what it basically is, it's not like a savings account because it pays more interest. So what they try to do is they try to take your money and put it in very short-term securities that will pay more than a typical bank account, like treasuries, government T-bills, maybe some municipals, just some short-term trading opportunities that they can invest your money in very safe fixed income security related investments. So that's why these money market funds can usually pay twice the interest of a savings account. So a savings account may be, say, maybe a savings account is 0.25%. A money market could be 0.5% or 0.75%. If you have a really good one, maybe it's 1% of interest. Oh boy, that you could get. So, but if you have your money in the bank and you're not going to do anything with it for a while, then you may want to put it into a money market. I went to the bank the other day, and the teller said to me, "Oh, would you like to talk to a financial advisor?" I was like, "No." And I was like, "Should I explain to her what I do for a living?" And nah, I'll just say no and move on. If I don't think I'd go for a bank's financial advisor because then basically who pops out probably. And I actually did this once. They had the retirement advisor was going to talk about the craft for school retirement, whatever. So I went, and it wound up being a former student of mine who was asking me questions about during some, like, okay, this is why I can't go to these things. I was just seeing if they had anything new to say, but usually it's all the same. All right. Okay, so going back to types of mutual funds, they did create, in response to the fact that mutual fund managers can't beat the indexes or ETFs are becoming so popular, more and more of these index funds have been created, which are mutual funds based off of indexes. And we have indexes for everything. There are thousands of these indexes for every single country, for groups or regions of the world, Asia index, America index, European index, Middle Eastern indexes, indexes for every single country. We have indexes for every single industry. So it's just lots of indexes. So they come up with an idea of creating index funds based on stocks or bond indexes that will trade like a mutual fund, but will have lower fees. Lower operating fees for the portfolio means lower fees for you. So it's a way of trying to get some money back from these ETFs. Then you can have sector funds, and these are going to look at industry sectors: software, semiconductors, consumer products, defense, energy, financials, any way you want to think of any industry that you could group together, there's a mutual fund for it. So these sector funds are looking to play certain sectors, because people know that in any particular time in stock trading history, there are some sectors that are doing very well and some sectors that are not doing well. So you want to move your money. The idea is to put your money in the sectors that are doing well, and then when they stop doing well, change it over to a different sector that's going to begin to do well. So because they go in a rotational period where, say, technology. Technology did very well in the 1990s, and it was a great sector to be in, but 2000 crash happens, horrible sector to be in. You don't want to be back into technologies until 2009. Suddenly technologies are hot again, and you want to put your money in technology. Same with the biomedical areas too. So every once in a while, some industries could take 10 years before they're hot again, and they're just cool. There's a cool down period. So some people may want to move between these different sectors. And then there's the socially responsible mutual funds that will only invest in stocks that are helping to reduce the world's carbon footprint, like wind generator companies, solar power companies, Tesla, making electric cars. So companies that are going to be ethical and treat the environment responsibly in what they do. Maybe companies that make food that's carbon neutral or non-GMO. I mean, Whole Foods could be an example of a socially responsible company. Maybe companies that give back part of their income to charitable trusts. So they would definitely exclude tobacco, alcohol, gambling, nuclear energy, other non-socially responsible companies. But studies have shown that the social responsible companies have a lower round of return versus the non-social responsible companies. So they've come up with the devil funds, which are based on companies like Playboy and gambling companies and companies that make slot machines and create a lot of waste and sell cigarettes. I read in Time magazine they have this artificial marijuana that smoke shops are selling that is becoming a real problem. So that would be, if that was a public company, that would be something you'd want to invest in. See Time magazine if you want to read the article. I had no idea something like this existed, but it does. Okay. Asset allocation funds. These are funds that, instead of jumping between different mutual funds as you go from a spring chicken to an old hen, and you have to jump between aggressive stock growth mutual funds to more income-oriented, safer funds as you get older, these asset allocation funds will look to build the asset allocations from a professional manager that in one aspect can make the allocation appropriate to your age. So first thing they'll do is make an allocation that will be safer: real estate, stocks, bonds. So the asset allocation fund will be a group of many assets, but then they can also start constructing it to your age group. And there are some of these, like Fidelity Freedom funds, where you can go in it as a 20-year-old, and the fund will grow with you, and you never have to sell it. It will constantly be changing its allocation to meet the age requirements you become as you grow older. They're going to charge you more fees for this, of course. There are a lot of mutual funds that are international mutual funds, where different regions and countries, and so if you want to easily invest in, say, France, there's a French international mutual fund. There's a Germany international mutual fund. There's a European international mutual fund. So you can take American dollars and easily invest in these foreign countries and these that are stocks are traded in foreign currencies very easily by just investing in an international mutual fund. And a few years ago, mutual funds for Chinese companies were very popular as that stock market was taking off considerably. A lot of people wanted to have some money over there. So international mutual funds is just part of the diversification process. Now, some of the services that mutual funds can provide you is automatic reinvestment. So you could just sign up with your bank account, and they'll take $500 out a month or $100 a week out to constantly invest into mutual funds for you automatically. So there's no real decision point on your point. It just happens routinely, and you can just build up over time. And they will also take any type of investments or capital gains and reinvest them for you as well. So And some mutual funds could be set up as a retirement plan. Will there be systematic withdrawals for you? So after you get to a point of retirement, then they'll be paying you money out of your mutual fund so you can live on it. So they provide all these services to make it convenient and easier for you to utilize mutual funds, but also going to increase the fees that you're going to pay. They will also, in some cases, allow you to move money between a family of funds with a very low exchange rate. They'll have a whole host of websites and phones and customer service operators there ready to assist you if you should need it. Now, so if you're an investor, you're going to want to use these mutual funds, I guess, as a way. If you don't want to devote any time to investing or researching anything in investments, you could just use these mutual funds as a way to keep invested in stocks, have somebody at least with some sort of professional knowledge keeping tabs on these funds for you. So all you have to do is just contribute the money, and hopefully they'll accumulate wealth and value. Now, speculation and short-term trading with mutual funds is discouraged, but some people may do that. But a lot of mutual funds built in additional fees and additional costs and commissions if you trade them too frequently, especially within 401ks or retirement plans. They generally frown on that. But conventional wisdom says that if you get, say, a group, probably only need like 5 or 6 different mutual funds to have a really diversified portfolio, and you invest in them consistently over a lifetime, they, based on past historical returns, will beat inflation over a long period of time and give you the best return possible for your money. So that's why a lot of Americans focused on their future potential retirement will invest a lot in these mutual funds. And the biggest mistake you can make as an investor is to get your first job and ignore your sign up for the 401k. It's such a huge mistake that now they've changed the laws to allow companies to force you into 401ks by automatically enrolling you in them. So you don't have a choice, because they found that people are indecisive, and they usually decide no when they find that their paycheck is going to shrink somewhat, so they don't enroll. So a lot of companies now are allowed to automatically enroll you in the 401k. You have no choice. You're just automatically enrolled, and your money goes in there. And then every year, they can even have an acceleration of how much contributed every year. But I would tell you now that as soon as you get your job, voluntarily or not voluntarily, sign up for the 401k and contribute the maximum amount of money that you can afford to put into it. So you will have a retirement. And for being in your age category that you are, you have a high probability of living over 100 years. You could possibly even live in your age bracket. Your life expectancy, the top end of it could easily be 150, 200 years. And you're saying, whoa, how is that possible? Well, if you invest in your 401k and your mutual funds properly, you'll have enough money to buy replacement organs, replacement body parts, life extension therapies and drugs, and this could greatly extend your life. So not saving in your mutual fund can contribute to a premature death, because you will not have the resources needed in old age to pay for all this expensive medical care that will not be covered by Obamacare, that you'll need to extend your life. At some point, they may even be able to clone from your stem cells a whole replacement body and brain, and they just transfer your consciousness into this new body. And then you're suddenly 18 again. So the only thing you have to worry about is accidental death, because there will be no more old age. They could develop a therapy that can reverse the aging process or stop the aging process that they've had actually some success with. That means that you won't be immortal, but you have a good chance of living a lot longer than, say, me, since I'm older. But still a possibility. So if you're going to select the mutual funds, you actually do have to do some work in selecting the mutual funds, as far as what mutual fund you want to pick, what family of funds, looking at the expense ratios, what type of diversification you may want. So there is some work initially you have to do to develop a portfolio, and that's the hardest part. Usually signing up your 401k, they'll give you like 30 choices of 30 different index funds and mutual funds, and how do you pick the right grouping of it? And that could be quite daunting of a task. You will have to do some research, besides the perspectives available from the mutual fund, the Wall Street Journal, Barron's, Morningstar Mutual Funds, Value Line, and different websites like Yahoo Finance all provide unlimited amounts, more than you could ever read, on strategies for what groups of mutual funds you should use to have a balanced investment. And typically, if you want my advice, I usually go with a large cap, a small cap, a mid cap, and then a couple index funds and a bond fund. So I kind of, and international funds. So I just kind of pick usually 5 to 7 mutual funds that cover pretty much all the investments in the world, and that way I have the most diversified allocation of investments that will produce a lower overall return, but a much safer overall return than saying having all my money in growth stocks in just the United States, or putting all my money in companies in China. Just buying Chinese mutual funds, Chinese stock-oriented mutual funds. That's very risky. So, but I like to have some exposure to China, and some exposure to Korea, and some exposure to Vietnam, and some exposure to Europe and United States, and some exposure to bonds and real estate. And so I always go with having a more diversified portfolio to kind of be like a shock absorber to the financial turmoil that can occur every so often. So if you're going to compare mutual funds, you want to look at the past performance. It's not going to accurately predict future performance, but at least you get an idea of their track record, what their tax structure is like, how much taxes you generally pay from these each year, the fee structure, how it's going to fit into your existing portfolio, and the skill of mutual fund managers. If you go to a mutual fund that had beat the market 5 times over the last 5 years, what you may not know is that the mutual fund manager who accomplished that has now left that mutual fund and went to a different one. So you may want to buy your mutual funds based on successful mutual fund managers rather than the successful performance, because generally, if you have a successful 5-year track run at one mutual fund, you'll get paid a lot more money by another company to move over and start another fund. So sometimes it pays to know the mutual fund managers. And then looking for whether you should need to figure out if you want load or no load, or closed-ended or open-ended mutual funds as far as particular investments. Now, the closed-ended mutual fund has a different way of calculating the return of that mutual fund, which is a pretty simple formula as far as you take the actual, to calculate the actual premium discount, you just need the share price minus the net asset value divided by the net asset value. And that gives you a percentage of premium or discount that it's trading at. Because the assets in the closed-ended mutual fund never trade at the actual, very rarely trade at the actual value of that mutual fund. So you want to figure out, is the share price at a premium or a discount? And this simple formula, share price minus NAV divided by NAV, gives you that percentage. And of course, different types of returns for mutual funds. You can get dividend income. If the stocks pay dividends, they pass it on to you. Capital gains, you may buy your mutual fund at $25 a share, and over 10 years, they may go to $45 a share. So if you sell that mutual fund, the difference between the two prices of capital gains you'll pay. And the change in the net asset value is considered a paper profit until you actually sell the mutual fund and capitalize on it, then becomes the capital gain. But also under capital gain distributions, this is where the mutual fund manager trades the stock inside the mutual fund, makes a profit, and then you have to pay the taxes on it. Not the mutual fund. The mutual fund company itself pays no taxes to the government on the capital gains profits they make inside the mutual fund. That gets passed on to you. The mutual fund management will pay taxes on the profit they generate in fees from you, but not the actual profits they generate in the mutual funds. This is an adaptation of our holding period return. And basically what they did here, instead of having a stock price here, they have the price of the mutual fund. So you take, just like this is the same way of calculating return of a stock, but here, number of shares you own in the mutual fund times the ending price minus the number of shares times the initial price divided by the shares at the beginning period to multiply by initial price. So this is just an adaptation of our holding period return formula for stock price, but in here we're utilizing it to calculate the return of mutual funds. Okay, so chapter is finally over, and here is what we learned. We learned the basic features of mutual funds, how they're different from other investments. We distinguish between open and closed-ended mutual funds, as well as other professionally managed types of investments in companies. We learned about loads, fees, charges. We talked about the investment objectives of these different types of mutual funds and what they hope to fulfill. We discussed the investor services offered by mutual funds to people who buy into these mutual funds. Talked about uses for investors, how they could utilize mutual funds for their own personal gain, and we talked about the sources of return and how to compute the rate of return on a mutual fund, which, as it's very similar to a stock. You got your dividends and your capital gains, and you have your beginning and ending prices. So this is all nothing new. Okay, so that is chapter 12.